Today we're going to get inside the trader's mind. We'll explore what your brain is actually doing when you're sitting at the screen, what's firing, what's shutting down, and most importantly, what the top 1% of profitable traders do that's so different. I want you to just take a second and think about the last trade that really went wrong for you. I'm not talking about the one where the market just moved against you and well, your analysis was just off. I mean the other kind, the one where you knew somewhere in the back of your mind that you should not be in that trade, but you did it anyway. We've all been there. Now, that wasn't a strategy problem, that was your brain. Specifically, it was the same part of your brain that fires up when someone uses cocaine. And look, I'm not being dramatic here. This is all documented neuroscience from places like Caltech. Financial decisions light up the brain's main reward center, and that releases dopamine surges that actually make it harder for the rational part of your brain to calculate risk. So, in this explainer, we'll start with some pretty sobering numbers. Then we'll dive into what's happening inside your brain when you're trading. After that, we'll pinpoint 6 key psychological traps. And finally, we'll look at the systems that the top 1% use to get around all this. Okay, let's kick things off with the numbers. Because before we can even think about fixing the problem, we really need to understand just how big it is. So, a huge study looked at 28 years of data from 8 million traders, and it found a pretty staggering truth. Somewhere between 74 and 89% of retail traders consistently lose money. Just let that sink in. For every 10 people who try to actively trade, at least 7, and maybe even up to 9 of them, end up with less money than they started with. And here's the really wild part, that number hasn't really improved in over 27 years. Think about that. Despite way better technology, despite better charting tools, despite all the YouTube tutorials, trading courses, and Discord communities, the failure rate is structurally almost exactly the same. And what's more, studies found that about 85% of traders who fail follow the exact same four-phase pattern before blowing up their accounts. It starts with some early optimism, right? Then comes the first real loss and the emotional kickback from that. And that leads to step 3, revenge trading, where you're desperately trying to get it all back. And finally, you hit account destruction, where both your psychology and your capital just completely collapse. So the really crucial question is, why? Why does this happen to so many traders across all markets? Well, the answer isn't in the charts, it's in your brain. See, deep inside your brain, there's a little structure called the amygdala. It's only about the size of an almond, but it is the primary reason that most traders fail. It's your brain's threat detection system, and it fires up powerfully the second your trade goes into the red. And when the amygdala activates, it basically hijacks your prefrontal cortex. That's the part responsible for all your rational planning. Research from MIT actually found that during market volatility, the function of that rational part of your brain decreases by 40%. So at the exact moment you need to be thinking most clearly, your brain's rational center is only running at about 60% capacity. Now let's look at the other side of the coin. When you win a trade, your brain releases dopamine. Yup, the same chemical we talked about earlier. And this dopamine hit motivates you to immediately repeat whatever it was that got you the reward. This is the dopamine trap, and it's exactly why a good winning streak often leads directly to overtrading and taking bad risks. Alright, now let's talk about maybe the most studied concept in all of behavioral finance, loss aversion. Groundbreaking research by Daniel Kahneman and Amos Tversky found something really profound about us. Losses feel roughly 2.5 times more painful than an equivalent gain feels good. The feeling isn't proportional at all, it's completely asymmetric. And this asymmetry has a totally devastating effect on a trading account. Because losses feel so much worse, your brain gets irrationally motivated to avoid them, which means you hold on to your losing trades for way too long. And at the same time, you cut your winners short just to avoid the potential pain of them reversing back on you. I mean, this single pattern all by itself is enough to destroy an account over time. Okay, so we've got the brain science, but how does this all actually show up in your day-to-day trading? Let's get really specific here. Understanding the neuroscience is good, but recognizing these patterns in yourself, that's absolutely crucial. There are 6 psychological traps that are responsible for the vast majority of trading losses. First up is FOMO, the fear of missing out. You know this one? The price is moving fast, everyone's jumping in, so you chase it, and you usually end up getting in right at the top. The fix for this is surprisingly simple and mechanical. Just wait for 2 candles to close after you feel that urge to buy. If the urgency is gone after that little pause, it was just FOMO. The second trap is revenge trading. You take a painful loss, and your first instinct is to immediately look for the next trade to get your money back. At that point, you're not trading the market anymore. You're just fighting your own feelings. The fix, a mandatory, non negotiable 30-minute break after any loss that really stings. Just walk away. Trap number 3 is confirmation bias. Once you're in a trade, your brain actively starts looking for information that confirms your decision, and it just as actively ignores anything that contradicts it. So here's the fix. Before you even enter a trade, physically write down the specific price action or data that would prove your idea wrong. Then watch for those signals just as closely as you watch for your profit target. The fourth trap is a classic, the gambler's fallacy. You've lost, say, 5 trades in a row, so you start to feel like you're due for a win and you increase your size. But the mathematical reality is that every single trade is independent. The market has no memory of your losing streak, it doesn't owe you a thing. And trap number 5 is overconfidence. Usually, right after a nice winning streak, you start to feel like you finally figured it all out, so you start taking bigger and bigger risks. But remember that dopamine system, the one that's making you feel invincible, is the very same one that's reducing your ability to rationally assess risk. Dot. Just remember, the most dangerous trader in the room is the one who just had their best month ever. And the sixth and final trap, analysis paralysis. You study a setup for hours, you look at every indicator, and then the opportunity just passes you by. You know, excessive analysis is often just the flip side of loss aversion. If you never enter, you can never lose. You have to accept that there is no such thing as a perfect trade, only a trade that meets your predefined criteria. So, how in the world do you overcome all of these traps? Well, let's look at that 1%, the consistently profitable traders. They're not necessarily smarter and they don't always have better strategies. What they do have are systems that make their psychology largely irrelevant to their actual execution. Think about it this way. When a retail trader watches a position go against them, they have to make a live decision. Do I hold on or do I close it? And that's the exact moment where psychology just destroys them. For a professional, there is no decision to make in that moment. Their predefined stop loss closes the position automatically. Psychology doesn't even have a chance to get in the door. They build these systems using 3 core practices. First, they remove those in the moment decisions by defining everything, entry, stop, and target before the market even opens. Second, they do a systematic self review. They keep a journal not just to track P&L, but to track their own behavior and find their psychological patterns. And third, and this is a big one, detachment. They know their edge only plays out over hundreds of trades. The results of a single trade is basically meaningless. Only the process matters. So, you see, the reason that 74 to 90% of traders lose money, it isn't really about strategy, it's about biology. The top 1% aren't immune to these forces, they've just built systems to bypass them. So, your starting point is just simple awareness. Now that you can see these traps, I want you to answer this question down in the comments. Which of those 6 has cost you the most money? Be specific. Let's try and make the comments on this explainer one of the most honest conversations about trading psychology you can find online.